In a recent presentation titled Blood-Curdling Scream, Jim Rickards made a bold forecast about how the stock market will play out. Rickards, regarded as one of the world's best economists, stated that we may be witnessing one of the largest market corrections in our lifetimes. He even went so far as to claim that the markets just let out a blood-curdling scream, and that many Americans will suffer as a result. In this video, we will look more closely at what he said in the interview and what he recommends you do to prepare for the coming months. First, Jim Rickards believes that the stock markets are currently in a gigantic bubble by any metric. He shows us a chart showing the market cap to GDP ratio to explain this. According to him, the market capitalization to GDP ratio is a decent indicator of how much money has been invested in the stock market in comparison to the size of the economy. He claims it is multi-billionaire Warren Buffett's preferred signal for anticipating market crashes. According to Jim Rickards, at the pinnacle of the dot-com bubble, the chart was at its highest point, and Buffett anticipated a fall. He was proven correct. For 15 years, the market did not recover. The indicator is now 113% greater than it was during the peak of the dot-com bubble, which Jim interprets as more easy money flooding into the US stock market than at any previous time in history. If this is taken away, the market will tumble even worse than the tech bubble. The margin debt chart is another chart he displays. The margin debt chart depicts the amount of money borrowed by investors to invest in the stock market. According to the graph, soon before the 2000 crash, margin debt reached around $500 billion as investors borrowed to invest in equities. Most people's debt-to-net worth ratio is increasing. Debt rose again just before the 2008 financial crisis as people leveraged their accounts. According to Jim, margin debt levels are at an all-time high today, with nearly $1 trillion of borrowed money floating around in the stock market, more than double what they were before the 2008 financial crisis, when the market fell by nearly 55%. And this excessive debt is cause for concern. They are also higher than during the trade war. As a result, he believes the ensuing crash will be one of the fastest and most violent correction in history. The last chart he displays is the Shiller PE ratio. The Shiller PE ratio, according to Jim, is a bubble indicator devised by Nobel Prize-winning economist Robert Shiller. It assesses how pricey equities are in relation to their earnings. According to what he reads, it has reached its highest peak since the Great Depression. According to him, the next stock market catastrophe would be different from previous ones, because the government and the Federal Reserve will not save the day this time. This is because in order to mitigate an economic or financial system disaster, the Fed has increased the money supply and lowered interest rates throughout the last few decades. He believes that the stock market will remain down for years, if not decades, like it did after the coronavirus crash or the 2008 financial crisis. This is due to the fact that the precautions we just outlined will not be effective this time. Why is Jim Rickards claiming that they will not work this time? He claims that for the last few decades, no matter how much money the Fed produced and pumped into the US financial system until last year, there hasn't been huge inflation at the proportions seen today. Prior to last year, he claims, inflation was averaging around 2% and had been dropped since the 1990s. However, inflation has risen this time because all of the money that has been injected into the economy to boost consumer spending is not reaching the consumer. It is being channeled into the bond market, the stock market, and the United States banking system. As a result, instead of pouring into the economy and causing inflation, newly generated money has been flowing into assets, causing massive bubbles in practically every area of the economy. This is because many people have realized that with the free money the Fed is throwing at the economy, they may get rich. He points out that it was recently reported that investors put more money into equities in a single 5-month period than they had in the preceding 12 years combined. With interest rates currently at one of their lowest levels in history, Jim claims that the Fed will not contain inflation by raising them, since every time it has attempted to do so, a catastrophic market crash has resulted. He claims that the Fed is in a difficult position because it must choose between hiking interest rates to prevent inflation and maintaining the bubble. People will suffer with any option, he claims. He claims that those efforts will fail since the current upheaval is the result of supply shocks. It's much more than oil. We are seeing enormous supply shocks almost everywhere we go as a result of the crisis in Ukraine and the aftermath from the coronavirus lockdowns. Everything is in low supply, from food to gas to electricity, across the country. Videos reveal empty shelves. He claims that the last time this happened was in the 1970s, when even the stock market was ineffective as a hedge. After 1965, the Dow Jones dropped by approximately 74% and did not recover for nearly 30 years. As a result, as prices rose, the value of people's retirement accounts fell. Another reason Jim Rickards believes the government and the Fed cannot assist is that boosting interest rates will inflict more harm than benefit. He uses Japan as an example, which went through this in the 1990s. Japan was in a roughly analogous situation in the 1980s, with a big asset bubble caused by low interest rates and easy money. Everything appeared to be in order since their real estate and stock markets were at all-time highs, exactly like America today. Then in 1989, when the central bank chose to gradually deflate the speculative bubble, the stock bubble burst and the Nikkei sank by more than 60% in only a few short years, resulting in what is sometimes referred to as the lost decade. As a result, Jim cautions that if this occurs, the market will crash precisely like the Japanese market did back then. Jim Rickards believes that a market catastrophe is imminent and that the time to prepare is now. He claims that if he were to select a date when he believes the whole thing will unravel, it would be in the middle of June, because the entire world is currently in limbo because everyone is waiting to see how the Fed will behave. He chose that date because it is when the Fed will convene to decide whether or not to continue raising interest rates. He believes that if they raise them by more than 0.25%, which seems increasingly likely, the markets will have a massive sell-off the next day. He suggests that you keep enough cash on hand to cover at least 3 to 6 months' worth of spending. Despite the fact that inflation is reducing the value of currency, he believes that most individuals will be wiped out in the early phases of the crisis as the market crashes and they lose their jobs, homes, and retirement funds. As a result, he claims that having a little cash on hand will keep you well insulated against the impending storm. Part of his justification is that the market needed time to rebound in 2008, according to Jim Rickards. Investors who keep their money in the market had to wait a long time for it to recover, whereas those who moved to cash and bought even a standard index fund near the bottom of the market could have quadrupled their money in the same time frame. To assist with this, he advocates converting a big portion of your portfolio to cash, because having liquidity limits your downside during a crash and gives you plenty of ammo to re-enter the market at rock-bottom prices after the massacre is over. This is in keeping with the maxim that the ideal time to buy stocks is when there is blood in the streets. Nick Giambruno offered this mantra. The Fed funds rate of change is astounding. Never before has it climbed by such a large percentage so quickly. This will startle the system. Bonds and housing, for example, are going to take a beating. The consequences of these rapidly growing rates will be devastating. And with that being said, it's time to end our video. Subscribe to the channel for more amazing videos like this. We'll see you with another interesting video.